Okay, hello everyone. My name is John O'Donnell. I'm the Chief Knowledge Officer of Online Trading Academy. My email address is on your slide at tradingacademy.com. And I want to thank the sponsors of this event, which is FX Street. Um, I think they do a great job of bringing content across the world. So no matter where you are located in the world, I've been asked by the sponsors to talk about what I call Obamanomics, 2009-2010 markets. This is a summary with specific uh, forecasts for what's going to happen in this first couple of years of the Obamanomics administration. I should have also titled my talk today Perception versus Reality in Globalization 3.0 Credit Bubbles and Uncertain Markets. Or I could have subtitled it further, How to Profit and Turn Crisis into Opportunity. Mr. Obama recently met with President Nixon, and actually President Nixon, wow, President Bush, kind of dating myself. And after that meeting and looking in the magic economics file that Mr. Bush's advisors are willing to share with the Obama team, they've decided to change the image of the U.S. dollar. So, what can I tell you? What can I tell you? I don't know what to do about that, Maud. What do you suggest I do? So, for those of you that um, don't know about Online Trading Academy, we started out as a proprietary trading firm way back in 1997, where in Irvine, California, where we created probably the largest trading floor west of the Mississippi River, primarily trading equities. Half our traders, and we were trading our capital, half were trading their own. Is that better? We sold our floor and morphed our model into what we've become, and what we've become today is the largest direct access trading school across the world. We've got about 143,000 members in 5 countries, and we're growing very, very rapidly. Um, the environment that we are seeing today is what I call a global deleveraging situation. I don't know what the banking industry looks like in your country, although I do pay quite a bit of attention to the global banks. But we are truly going through one of the most uncertain periods in the history of world capitalism. When was the last time you saw or even read about a coordinated effort by the top 10 central banks of developed countries across the world to literally recapitalize and deleverage their balance sheets? And this is incredible. We haven't seen this kind of activity since the 1930s. Some are forecasting, after the Dow peaked in October of 2007 at about 14,164, that we were in for a complete free fall back to below where this bull market started. I'm not necessarily forecasting that, but I do see a tremendous amount of pain that we're in. And basically, I want to talk to you today about the fundamental root cause of the economic crisis, the global economic crisis that we face, and why your intelligent decision to learn to trade Forex and to avoid or commodities and equities and the bond market has been a very good decision, because I believe there's going to be, in the Obama administration, globally, a tremendous flight to safety and cash as this uncertain period of economics continues to unwind. This is the fundamental problem that we face in America. One, we absolutely borrow $2.5 billion a day from global savers. We have seen in the blue line here that total debt as a percent of GDP has grown to over 300% of GDP. We've seen that our personal savings rate in America, on this axis on the right, has dropped from 12% of our income, and today we're lucky if our savings rate is 1.5% of our income and has been below zero. So here we are in a situation that the Obama administration has inherited, and we have a real challenge ahead of us. Okay? Now, to put this in perspective for you, this is total credit, and what we are experiencing after the Reagan administration took power in the early 80s was a phenomenal credit bubble was formed. And we've seen this credit bubble before, way back in the 1920s, and of course the credit bubble burst in the 1930s, which we call the Great Depression, and it precipitated and spread across the world. I want you to note that the long-term moving average of debt as a percent of GDP is somewhere in the vicinity of about 120 to 135% of GDP. And notice we financed World War II, the Korean War, Vietnam, and Reagan was elected right about here. And as a culture in the States, we went on this tremendous credit binge. And today we have credit as a percent of GDP over 300% of GDP. What we are going through is that this credit bubble is bursting, and that there is both a voluntary and an involuntary component of deleveraging take place. Now, you know who the involuntary players are. What you may not know or are focused on are who are the voluntary deleveraging community. So basically, if you think about this is bank credit as a percent of GDP, which is a subset of the total credit profile of our country. Today, we've got bank credit alone in the U.S. about 66% of GDP. The long-term average of debt as a percent of GDP is on this red line right here. Now, this chart goes from the 1950s forecasted through 2015, and you'll see that the average is only 44% of GDP. So what we're seeing is that our investment banks, our hedge funds, our commercial banks are deleveraging. And the thesis of my presentation and how I've built my trading plan going forward is that there is going to be a flight to safety as this credit bubble continues to unwind and we get reversion to the mean, which comes all the way back to the average, which will be it'll probably go below the average because it's very, very common to overshoot. Okay? We've seen this process before, and it's in Japan. Japan had this tremendous commercial leverage bubble. Sorry, folks. Bear with me for a second. There we go. Here we are looking at this. What's the problem here? Here we are looking at this in Japan. I think the Obama's administration, with their proposal to do infrastructure spending, is going to look very, very similar going forward to the Japan bubble as it unwound. Japan did a remarkable amount of infrastructure spending to stimulate their economy, and they have been in deflation for 18 years. And notice the pattern of this deflation was reflected in the Nikkei index with a series of counter-trend rallies, and virtually all of the counter-trend rallies have failed, and not only has their stock market been down over 80%, but their real estate market crashed with it and has stayed down as well. So we're in for some tough sledding as we go through this thing, and we'll see where it finally precipitates. But at least the first couple of years of the Obama administration, I'm looking at over $1 trillion deficits that is going to cause a tremendous amount of pain. Now, how can I say that we are going to have a net deflation in a period of time where central banks of the world are printing and making available credit to the tune of, in excess of $7 trillion alone in the United States? How can we still end up with deflation? And by the end of my presentation today, you'll understand why the forces of inflation and the forces of deflation are fighting one another in the global marketplace, the net effect is capital is being destroyed at a faster rate than central banks can print money. I know for most of you that sounds unrealistic, but I have found it to be the case, and I have found it precipitated in the price of various financial instruments and commodities that we're experiencing right now. The Japanese market continues to fall. In the blue slides, we see the Nikkei index has fallen from 18,000. Today, it's lingering around the 8,000 level. And of course, the Japanese Purchasing Managers Index in red has precipitously declined from 56 below 40 today. And for those of you that follow this economic indicator in various countries, the Purchasing Managers Index, anything below 50 is viewed as a contracting economy. Anything above 50 is viewed as an expanding economy. We're also seeing a confirmation of deflation. This chart is compliments of our friends at Elliott Wave. We see that since 1999, that yields on long-term Treasury bonds have fallen precipitously from 6.5% here at their peak, and just recently this month, we hit an all-time low in yields in the vicinity of 3.1% on 30-year Treasury paper. So what we've seen is a further confirmation and eroding and a flight to safety. Gold is not playing the strong role as a safe harbor during times of economic turmoil like it has in the past. In fact, we're seeing 30-year Treasury paper provide that role. What other evidence do we have that deflation is with us and accelerating is the CRB index. This is the CRB index, the fluctuation of the CRB index, going all the way back to the 1978 era. And now we're seeing a precipitous slide, and I wouldn't doubt that we're going to move all the way back to the 250 to 300 level on that index. We continue to see our financial institutions, the equity in our financial institutions, absolutely implode. We've now seen the demise of Lehman Brothers, Bear Stearns, Washington Mutual, Wachovia. Merrill Lynch has lost their independence. I saw Ace Greenberg interviewed on Bloomberg last night talking about the investment banking industry as we know it in America no longer exists. Morgan Stanley and Goldman Sachs have now converted themselves into commercial banks. Merrill Lynch has been acquired by Bank of America. So our investment banking industry as we know it does not exist, and it's not going to resurrect in this next cycle. This is very, very highly uncertain period of time. Now, I love to show this chart because right here, this is the NASDAQ index where I had my first appearance on CNBC right here in 2000 at the peak of this bubble. Then, of course, that bubble burst and retraced 100%, almost 100% of where it moved. My wife said, my God, John, after you appeared on CNBC right here at the apex of this bubble, $8 trillion worth of wealth disappeared. What did you say to those people? Well, I said, I suggested that you ought to get out of the market. I just didn't know that they were all going to do it at the same time. I said, honey, I don't know what caused that. What do you think caused that big decline in the market after my appearance on CNBC? She said, I don't really know what it was, but I think you have the perfect face for radio. Folks, the jokes aren't going to get any better. You need to lighten up. This is the NASDAQ 100. We've seen the NASDAQ 100, also known as the QQQs, completely lose all of their gains from the early 1990s through 2000. We've attempted to have this rally, and I think we're going to go back and test this 1,000 level before it's over with. I'm looking for a continued erosion of these markets. My personal game plan is to sell all the rallies. I both trade equities and Forex. I think your choice to learn to trade Forex, there is a flight to safety. Cash equivalent is considered a flight to safety. Now, right now, we have a lot of money coming into the U.S. dollar vis-a-vis the euro, vis-a-vis the pound sterling. I think you're going to continue to see that role play out because with all of our problems in America, we started to clean up our balance sheet in America of our banking institutions long before Western Europe did. I think there are more problems in Western Europe on a relative basis than there is in America right now. I think Asian countries and central banks are starting to recognize that very clearly. And so since we started to clean up our mess earlier, I think we're going to come out of it before Western Europe and Asia does, as we find a tremendous consolidation in our financial services space. I wouldn't doubt that by the time the dust settles, either through mergers or FDIC takeovers, we lose in excess of 1,000 banks. That wouldn't surprise me at all. We're seeing multiple sectors like our home builders, our mortgage brokers. Obviously, you've read the press about our automobile industry. It's estimated we could lose as many as 2,000 automobile dealers as the big three auto companies consolidate and clean up their balance sheets. So what we are going through is that, recognized in the previous charts, it took us multiple years, multiple decades to build this credit bubble, and now we're going through the deleveraging process. Again, some of it's voluntary, some of it is involuntarily, but Obama's inherited this from the Bush administration, and Bush didn't create all the problems. He certainly didn't do a lot to clean up many of the problems, and I don't want to make this political, but the first couple of years of the Obama administration are going to be very, very difficult years economically. And we're already starting to see the symptoms of those challenges precipitate. This is a very interesting chart. In blue is the Dow Jones Industrial Average from 1921 to 1929, and then 29 to 32. And then in pink is the Nasdaq bubble. So I've laid the apex of the Nasdaq bubble in purple here, with the 1929 bubble of Dow in blue. And look at the bear side of this equation. Look at the high correlation of the expression of fear. All these bubbles are, in my mind, in other words, we've been at this. We've seen these pictures before of the creation of these bubbles, primarily precipitated by the availability of cheap liberal credit. And then we've seen the unwinding of the bubble, and they have a remarkable pattern of similarity. Now remember, here we are in 2008. It's remarkably different than the 1930s, but yet this expression of fear and greed is remarkably patterned. I might note that after the 29 crash here in blue, adjusted for the Consumer Price Index, it took over 25 years for the Dow to get back to break even. So my research indicates, and this is further confirmation in this next chart, my research indicates that once these secular bear markets get running, they can last for a long period of time. In red is the Dow of the 1930s, that bubble bursting, and in blue is NASDAQ today. And again, look at these remarkable similarities of expression of fear. I have found a higher correlation in the expression of fear, which are bear markets, than in the expression of greed, which are bull markets. Let's go forward a little bit quicker. This is the Chinese bubble. This bubble gave the Online Trading Academy graduates a very, very clear signal. Back in November of 2007, we started to see, even though their economy was still growing, assuming you believe the Chinese economic data of 9 to 12% per annum growth, the economy for the Chinese market's been growing at those rates for 15 years. Granted, coming off a very low base, 50 years of communism, but they are one of the very fastest growing economies in the world with their bipolar system, which is totalitarian communism with a module of capitalism. Well, even with the Olympics coming up in the summer of 2008, we saw the Shanghai Index burst. Today we have it down here in the vicinity of about 1900. And again, I believe this index is coming all the way back to where it started, which is approximately 1,000. And this was very clear to us over a year ago when this bubble started to fall apart. This is the CRB index in blue. This is the Reuters CRB index in blue, going from roughly 460 down here below 280. And over the top of it, of course, with China's Purchasing Managers Index in red, collapsing from 55 below 50, again, a contraction of their economy. We were being told about this contraction earlier this year, and you combine that with the leading indicator, the decline of the Shanghai Index, the previous chart, and of course the rollover of commodities starting about mid-year this year and a complete collapse in commodity prices, is pretty straightforward that we're in deflation, ladies and gentlemen. We saw this precipitate in the Russian stock market, the RTS system. The Russian stock market has collapsed in blue on this axis over here from 2,400 down below 600. We saw the price of oil, of course, collapse this year from a 147 peak. Today, it's in the low 40s. And I think it's going to have a difficult time holding $40 a barrel. We are in deflation. Now, what's happening when you see the price of oil and when you see the CRB index collapse, we are going through what I call globalization 3.0. The globalization 3.0 storyline, or the theme at which we trade, is a very important theme. It was outlined in a book by Thomas Friedman. The title of that book, if you haven't read it, you ought to pick up a copy of it at Amazon or your favorite bookstore. The title of that book is The World is Flat. And I would encourage you to get that book and study it. Just don't read it, but really study it. In times of deflation, cash is king. Cash and cash equivalent actually appreciate in purchasing power. When you see the price of real estate and stocks and commodities and corn, wheat, base metals, precious metals declining, when the cost of labor is declining, you know that cash is appreciating in purchasing power. I can buy more BTUs of energy and gasoline today than I could a year ago in America, and we are seeing an appreciation in cash and cash equivalent. So your choice to learn to trade currencies as an asset class is a very, very valuable skill to have. In America, half the homes in America have exposure to the stock market, but yet probably one home out of 10,000 in America have a relationship to the currency market. Other than we buy foreign-produced goods through an American retailer, we basically are struggling with deflation. The title of that book, someone's asked me to repeat the title of the book. The title of the book is real simple. I think I'll type it in here. The World is Flat by Tom Friedman. Get that book. The World is Flat by Tom Friedman. Friedman talks about globalization, and talks about us being in three eras of globalization. Globalization 1.0 was from 1492 to 1800. It was financed by monarchies. Think of the United Kingdom and Spain creating new empires. Globalization 2.0 was 1800 to 2000. It was financed by private capital, corporations, both credit and equity. Companies like GE, Coca-Cola, IBM, Hong Kong Shanghai Bank, etc. They were seeking new markets. They weren't there to create empires. And then globalization 3.0 is where you and I live, love, trade, must raise our family, and protect our capital in today's world. And it has been financed so far, because it started around the end of 2000, with private capital, individual capital, specifically human capital from India, China, Eastern Europe, South America, Middle East, Africa. 3 billion new players coming to the global marketplace to buy, sell goods and services the world produces. And they're a mouse click away. And they're a mouse click away from cannibalizing your income, because much of their productivity today can be sourced and distributed through modems because of this enabling technology of the internet. And we have something known as global wage arbitrage. There are going to be some companies that survive in this environment. There are going to be companies that fail in this environment, just like every other major transformational period of history. Now, what are the 10 macro forces that are accelerating the drivers for globalization 3.0 trends that you and I are going to have to adapt to? Are the companies that we work for, the companies that we own in our pension plans? Who's going to win? Who's going to lose? Now, our plan at Online Trading Academy is to use these 10 macro forces that are driving the accelerated rate of change, and there's no question it's an accelerated rate of change the world has never seen before, as these 3 billion new players get integrated in the global marketplace. Is basically we want to build a trading plan and own those companies that are going to win, and either short sell or avoid those companies that are going to fail, depending on how aggressive we want to be in our trading plan. But the drivers have been this. One, the fall, the collapse of the Berlin Wall, the collapse of communism. Communism's collapsing everywhere. It's a failed system. 2, India's move from being an insular society economy. 3, the spread of cheap PCs and software and bandwidth to over these 3 billion global users, which gives them access to the marketplace. And remember, they don't need to go through immigration to cannibalize your income any longer, because they're a mouse click away. Open source operating software trends, which is going to make software user friendliness improve and continue to improve. Over $1 trillion have been invested to install fiber optic systems. That's done. Automation software via the internet has just absolutely raised productivity and cannibalized many jobs. I mean, look how many jobs have been cannibalized by voicemail and email, as an example. And of course, in the United States and probably many of the other developed countries, intermodal transfer of goods which has created this environment we call just-in-time inventory system delivery efficiencies. Intermodal transfer is where we take these big containers that come in off ships across the world where goods have been produced. We lift them with a crane, put them onto a rail car, then we rail car these containers of goods all across the United States and various other developed countries. And then what's happened is that the container itself actually becomes the warehouse, and of course the goods are delivered to a factory just in time to be put into the manufacturing process. And of course the rise of China and its role in capitalism. Now let's learn something from the globalization 2.0 period. This is globalization 2.0. This is from 1800 to 2000. The way I like to measure the performance and economic health of a country is its stock market, its equity market. Now this is the performance of the U.S. stock dollar in constant dollars. I'm using the dividend adjusted market index in 1999 constant dollars over 200 years. This is globalization 2.0, 1800 to 2000. This was a remarkable period of time. There was more wealth created in the world between 1800 and 2000 than the rest of the centuries combined. But it was a volatile period as well. Look at this. We had boom, bust, boom, bust, boom, bust, boom, bust. We had multiple periods of boom, bust cycles with various political administrations. And remember, from 1800 through 1971, right in here, America was on a gold standard. Our currency was convertible, as the whole world's currency systems were convertible into a fixed amount of units of gold. Now, this is a proprietary indicator known as the price-to-resources ratio that takes about 6 econometrics and measures and smooths out all this data, and it gives us a little different picture, but the same message. We had 1, 2, 3, 4, 5, 6, 7, irrational bull market extremes of valuation. We also had 1, 2, 3, 4, 5, 6, 7 irrational extremes of bear market valuation. I want you to note that none of them were sustainable without exception for over 200 years. Now, we believe the trend is going to continue, but the peaks are going to get higher, the valleys are going to get lower, and we think the cycles are going to get closer together, which means that the volatility is going to continue, and it's going to be stronger, and it's going to be more frequent in its application. Now, this table takes the previous slide, and it shows you the period of time we had secular bear markets and the duration of years those bear markets ran. And this table over here takes the period of time from the previous chart and where we had bull markets and the length of time the bull markets ran in equities. Now, I want you to note that when these secular bear and bull markets get started, they can run, history shows us, they will run long periods of time. And I don't think this upcoming period is going to be any different. Let me go forward here a little bit. The Dow theory right now is confirming, which is, for those of you that are not familiar with the Dow theory, it was created in the late 1800s by Charles Dow, the inventor of Dow Jones Publishing. It takes into consideration the Dow Jones Industrial Average and the Dow Transports Average, and it is giving us a very bearish picture going forward. Let's talk about housing a little bit. The housing crisis in America is still alive. We have not reached a bottom yet. We certainly have not reached a bottom in the housing market in Western Europe. And in the United States, we're still seeing, I think we're much closer to the bottom today than we were a year ago. But my feeling is we've got probably another 24 months of pain in our housing market, depending upon what city you're located in the United States. But the bursting of the home builders and NASDAQ, as shown on this chart, shows you that it also is patterned in its expression. Let me go forward here a little bit. I want to talk about the root cause of the U.S. subprime credit crisis. You've read a lot about this, about blaming President Bush, for the subprime crisis. In fact, the root problem of the subprime crisis goes all the way back to 1977 in the Jimmy Carter administration, when, with a Democratic Congress, we passed the Community Reinvestment Act in 1977. That was accelerated by President Clinton's watch right here in 1995, when we had a Republican administration, by the way, and he accelerated the Community Reinvestment Act. And then, of course, all hell broke loose and the credit bubble burst on Bush's watch, where we had both a Republican and a Democratic Congress control. Now Obama gets to inherit it. Not only does he get to inherit the subprime mess, are the latter stages of the subprime mess. Most of the pigs through that python for subprime, but we're not quite finished yet. And now he gets to inherit the automobile blow-up sector crisis. You know, you're talking about $100 billion of debt between GM, Ford, and Chrysler. Again, most of that debt is unwinding voluntarily. Some of it will unwind involuntarily. My feeling is we're going to pass some kind of a Band-Aid solution here this week, and then I wouldn't doubt in first quarter of 2009, one of these companies is going to disappear. The top candidate to disappear is Chrysler, and I think one or more of these companies are going to end up in bankruptcy. And I think their balance sheets are going to get cleaned up in bankruptcy. Bankruptcy is a cleansing process to convert creditor debt into equity. It's estimated over 30,000 employees are going to lose their job. and it's estimated that over 2,000 automobile dealers in America will be required to close their doors, to downsize. Why is this happening? Well, automobile sales in America are off over 30%. This is called demand destruction, and we're the biggest automobile market in the world. We've seen demand for automobiles fall from 17 million units down to about 10, 11 million units. And all of the automobile companies in America, even Toyota, Honda, and Nissan, many of which have plants in the south of America, are under a lot of pressure right now because there is a deflation going on, ladies and gentlemen, and Joe can't borrow money against his home. I remember a newspaper article I read about a year ago in Southern California in 2007. 35% of the automobiles sold in the state of California, and we're the top automobile market in America, were financed with mortgage equity withdrawal. People were borrowing money against their home to finance their automobile purchase. So we're going through a lot of contraction here. Our unemployment rate is getting ready to push up around 8% very soon. I expect it to go back where it was in 1982, which is about 10.9%. And I think by the time we're headed in that direction, I think it'll happen within the first 18 months of the Obama watch. The gray bars on this chart shows you periods of time where we had recession. We're already exceeding previous unemployment levels, and I think we're well on that direction now. I don't know if you saw the report on Bloomberg last week or not, but during the month, I guess it was October, or maybe it was November. Maybe it was November. We lost 522,000 jobs. We'll lose over 2 million jobs this year in America because of this recession. This is what it's looked like in previous cycles. Again, the gray bars were periods in America. This is the monthly change in non-farm payrolls from 1960 through 2008. The gray bars are periods where we've had previous recessions. When we go red, these are jobs that we're losing, and we're probably going to go back to this level. We very well could go back to the level of the mid-70s, which was very, very brutal, extremely brutal. Unemployment rolls are going up. It's getting to be pretty tough. Could you go over the Dow index and correlation to the gold index? Yeah, let me see if I can find that for you. Let's see if I can't do that. This is a very important thing. What we're finding is that these mortgages in the secondary market are not finding a bid, and that's caused a big problem. Let me show you something for those of you that live in Europe. This is a very important chart I haven't shown before on FX Street. This is the total residential mortgage-backed securities that are issued as a percent of GDP. Now notice in Germany, France, and the U.S., debt, subprime mortgages, are their equivalent in credit quality, as a percent of GDP was less than 1%. It's about half of 1% in America. But look in the UK, it's over 7% of GDP in the UK, which means that the UK problem of toxic mortgages as a percent of GDP is like 14 times worse in the UK than it is in America. It's about 6% of GDP in Ireland, which means it's 12 times worse. Okay? Can you imagine that? In Netherlands, it's 10 times worse. In Spain, it's 7 times worse. In Portugal, it's 6 times worse. So Western Europe has deeper financial problems than we have on a relative basis. They've taken longer. They have less transparency in their banking system. They have more toxic paper that is a candidate to become insolvent and go into default as a percent of GDP than we have in America. And I'm looking for the economic crisis in Western Europe. And I think the fact that the dollar has been appreciating against the euro and the pound sterling has reflected this. And I'm very bullish on the U.S. dollar. through the rest of 2009 vis-a-vis. I wouldn't doubt that the dollar euro goes back to 1-to-1. I wouldn't surprise me a bit. The pound sterling, I could see the pound sterling going down to 125, 110, but I could see the euro. Remember, the euro started in 2000 at 80 cents, went to $1.60. I could see it certainly going back to 1-to-1, back to parity. That wouldn't surprise me a bit. And part of the problem, of course, with this problem with real estate is that Joe, the average Joe, can't borrow money against his home to finance his conspicuous consumption and lifestyle. Banks don't want to lend. Banks are trying to clean up their balance sheet. They don't even trust one another. And, of course, the problem continues. Debt as a percent of GDP continues to grow. We'll probably have over $1 trillion deficit next year. And, of course, our savings rate continues to plummet because Joe's losing money in his stock portfolio, his 401k, and his home equity continues to erode in this environment. So we're set up for what I call deleveraging. And all of this is synonymous with bank debt as a percent of GDP falling from 66% of GDP back to the long-term moving average, which should be below 44% of GDP. I expect it to overreact. It may take 2, 3, 4 years. I don't know how long it's going to take for the deleveraging process to take place. But it's going to take place, and we're already started it, and we're well into it. What symptoms do we have of this? Well, the symptoms we have of this is that bank earnings are deteriorating dramatically. And it's going to continue to deteriorate until it runs its course, and there will be massive consolidation in America in our whole financial services industry. Charge-offs for real estate loans, commercial loans, credit card loans, automobile paper, all of this sector is heavily stressed. And all you have to do is look at the equity price of our major banks, Citibank, Bank of America, Morgan, JP Morgan, and now Morgan Stanley and Goldman Sachs. I mean, they've now converted themselves into commercial banks. Let's move this along a little bit, if you don't mind. Let me see where we are here. Here's further evidence of the mortgage equity withdrawal. Are we here? Let me get this going through a little faster. I'm looking for earnings to precipitously decline for 2009. Here are the earnings estimates that have come out. The consensus earnings estimates by Wall Street. In March, they were thinking that the S&P in 2009 would earn 81.52. They're now down below 40. That's probably the last number I saw was about 39. And I think that might even be a little bit optimistic. I'm looking for a very, very weak 2009. This is a very interesting chart, and I think I'd like to kind of end on this. This is the S&P normalized to 100, going back from December 1971 through May of 76 in orange. And this is the S&P starting in September of 06 in blue, laid over the top of this, mimicking the rate of change in the S&P on its way to a 50% decline, probably sometime in the vicinity of June of 09. Then there should be a rally into September of 2010. The forecast on an Elliott wave forecast would be for an S&P to decline and probably somewhere in the vicinity of 676 using my Fibonacci retracement ratios. We can see that happening with the S&P going back to about 676. With that, I'd like to answer any questions you might have. My name is John O'Donnell. My email address is pretty simple. It's john@tradingacademy.com. You're welcome to email me. Much of what I've done, I think this presentation is going to be recorded and archived on the FX Street website. Much of my other work has been recorded. Here's a question, John. Do you think after this deflation period, hyperinflation is around? That's a possibility. Deflation could get so bad that the central banks of the world just continue to flood the system with money and dilute the currency specie into a hyperinflation rate. That's a very real possibility. But keep this in mind. They're printing trillions and trillions of dollars throughout the world. They're going to try to reflood the system. In America alone, new credit plus access to credit is in excess of $7.5 trillion. And it's just like putting your finger in the dike. It has not stopped real estate prices from falling. These deflations are not going to finish until real estate in your country finishes its decline. And we're not even close to that in the United States. Can I view these charts somewhere on GDP? Contact me, john@tradingacademy.com. Is the Amero a reality? I do not believe the Amero story. I think it's a fraud. I don't believe it. I'm willing to be, but I'll tell you what, if you believe it and you think there's a probability of the Amero, you need to load up on gold. You need to own as much gold as you can possibly get your hands on. But I'm not convinced the Amero story is real. Any other questions of me? If not, God bless you all. Good luck. Please visit tradingacademy.com. Lots of my work has been archived there in the home study section under recordings. And I wish you all the best of luck. Yes, Richard, if you want to buy a home, hold off. You're going to get a better price a year from today.